I know. Whole life insurance. It's a scam. It's a waste of money. You can't go 10 minutes in any financial space without hearing that from somebody that says, run away if somebody tries to sell you whole life insurance. The future of whole life insurance is not like the whole life insurance you hear about from a typical financial professional or even your typical insurance agent. I will posit that it's evolved into an incredible financial tool that demands a place in any portfolio. You're skeptical. I can tell. And I don't blame you, but give me 5 minutes to show you. Not 5 minutes to flood you with marketing fluff and sales pitches. This channel is about education first and foremost. And we dig into the details that you just don't get anywhere else. So do me a favor, hit that like button, subscribe to the channel if you haven't already, and then give me 5 minutes starting now. Now, we are constantly scouring the products available in the whole life space for 5 main things that elevate these from an expensive death benefit product to an exciting, versatile financial tool. Those are ownership, flexibility, strong growth, liquidity, and favorable loan options. When it comes to ownership, we want to own the company. We want to be a mutual partner. We want that company to be a strong financial partner with a strong dividend paying history. We want the flexibility to have a low premium commitment with a high premium paying possibility. What that means is we don't view these products as how much you have to put into it, but really, when you own something that's like what I'm going to show you, you end up getting excited about making a premium payment. And it becomes more of how much can I put into this? But in the event of financial road bumps, you have the flexibility that you can reduce that commitment. You're not committed at such a high level that it's going to cause you other financial problems in your life. And the big reason why we want the ability to put high premiums into these things, strong growth. They have a high internal rate of return, massive liquidity. We're talking high early cash value in the very first year, fast break-evens, and favorable loan options. We want low or no net cost to borrow. Ultimately, you want to be able to put your money somewhere that you trust that it's safe. You get the advantage of owning part of the company with where you're sending all of this money. And that's going to lead to high rates of return. And throughout the ownership period, you have massive liquidity so that you can still go out and do other things with those dollars. Now, tell me that doesn't sound like something that has a good place in any portfolio. There's currently 2 products that stand above the rest in these 5 categories, with one being better than the other depending on your specific goals around the funding. Let's look at the numbers of one of these products. Before we look at a great design on a great product, let's take a look at a not so great product and a not so great design. But this represents the typical numbers you might see if you go out in the market shopping for whole life at your neighborhood property and casualty insurance provider. For $5,000 a year, a 47-year-old male, you could get $300,000 of whole life insurance. And 20 years down the road, you've put $110,000 into this thing, and it's got $134,000 in cash value. And the overall death benefit, because you've been earning dividends, is $331,000. By the time you get 40 years into this, you're now 86 years old. You've paid in $220,000, and the cash value is still less than half of that at $388,000. And the death benefit, due to those dividends, has now climbed to $482,000. A lot of people buy these products every single day because of salesmen. This is clearly not a great financial tool when you've got 40 years into it and you're not even double the money that you've paid into it. And in fact, at 40 years into this policy, that cash value represents a 2.59% internal rate of return. And the death benefit, if you had died that year, based on all the money you paid into it, that death benefit represents a 3.51% internal rate of return. Internal rate of return means that's the equivalent as if that money had earned that rate of return every single year prior in that policy. Now, at least it's positive. They're getting out more than they put into it. But it's hard to say if this would beat putting your money almost anywhere else. Certainly in a high interest rate environment, you could just put your money in a checking or savings account, or you could put it in treasuries and get a higher rate than that. Now, that might not mean you can get that over the course of 40 years because rates go up and down. But in general, you're barely beating inflation if they can keep inflation down to 2%. Let's move over here to a better product. This is just a better product in general with a stronger dividend paying company. In this situation, your death benefit's $300,000 and it's not $5,000 anymore that you're paying. The other one was $5,500. This one, you're going to pay a little bit more. You're going to pay $7,161. Now, this is for a 48-year-old. The other one was for a 47-year-old. This one, you're 1 year older. This just happened to be when I ran these illustrations. Still the same $300,000 death benefit. And 20 years into this, let me preface this by saying this is not the future of whole life just yet. This is just a better company with a stronger balance sheet. But this product is not optimally designed for the future of whole life insurance as we envision it. Still, though, the numbers are quite a bit better. At year 20, the cash value is $199,000. In this case, you've paid in $143,000. So you have quite a bit more money than you paid into it. In fact, our internal rate of return on that cash value is already over 3%. Remember, this other one only had cash value of $134,000. And you paid in $110,000. There's about $24,000 more in this other design than what you paid into it. And in this one, we're pushing $56,000 more. That internal rate of return on that first one was only at 1.84%. And here we're at 3.04. When we get to 40 years in, this one now, we have paid more money into it, $286,000, but the cash value is well over 2 times higher. We're at $745,000 with an internal rate of return of 4.21%. And the death benefit, $877,000. So if you were to die here in policy year 40, that internal rate of return on the death benefit, 4.86%, while this other one was at 3.51. These are clearly significantly better just by upgrading the product to a better company that pays out a consistently much, much higher dividend. But we can make it better. We can make it better by doing what's called a blended design, where we're going to blend in some supplemental term insurance. In this scenario, we're also going to fund it at a much higher level, but for a shorter period of time. That same $300,000 death benefit, the government will allow us to fund it at $18,000. The minimum that you're required to put into it is only $4,155. Remember, we wanted flexibility where if we needed to reduce what we're putting in, we have the ability to. But if we're getting good returns on this thing, we're going to want to fund this as much as they will let us. And by year 20, we've put in $309,000. We stopped funding it after 17 years. We've put in a total of $309,000 and our cash value, $549,000. By year 20, we've got $140,000 more than what we paid into it in this case. Same death benefit starting out, but now the death benefit has climbed up to $868,000. Our internal rate of return on that cash value, 4.68%. That means this is the equivalent as if we earned 4.68% on $309,000 every single year for the last 20 years. Now, what does that sound like to you? That sounds like a good bond. And in fact, that's the place that we like to look at these in relation to an overall portfolio. How would we like to have a company in our portfolio that we own that pays out a consistent dividend? If I happen to die, it's going to pay out way more money than we paid into it, but I'm a financial partner of theirs, and when they make profits, I get to participate in them. And the cash in here is accessible. It's liquid and accessible. So this is after 20 years. Internal rate of return on that death benefit, 8.29%. If you were to die at 20 years into this, 8.29% is what that's paying out. That's the equivalent of if you had just put that $309,000 into a savings account. If you actually grew that at 4.68%, but you died in 20 years, your beneficiaries would only get that $309,000. Well, they would get the $549,000 that it grew into. But because this is life insurance, if you died, they get way more than that. 8.29%. That's basically the equivalent of what you might expect in a long-term portfolio in the actual stock market. And we don't want to die, and we don't necessarily expect that we would die around age 68. But if you continue to live, this just gets better. Look at year 40 with this optimally designed policy. You've put in $309,000. You've got $1.5 million in there in cash value. The overall death benefit, $1.76 million. So if you're still kicking, you've got the internal rate of return on that cash value of 5.05% for the last 40 years. If you could buy a bond today, 40-year bond, paying out 5.05%, I would venture to say that would be a very popular bond. And in here, we basically have that opportunity. But if for some reason you die before making it to age 88, it pays out quite a bit more than that. And in this case, even at policy year 40, which is age 88, that death benefit, the internal rate of return, is the equivalent of that cash that you set aside, making 5.47%. And remember, this is tax-free. The death benefit pays out tax-free. If somebody had to pay taxes on those, this is more like the equivalent of a 7 or 8% internal rate of return. What a powerful product. Now, this typical lifespan is somewhere around here, 87, 88, but this cash value just keeps climbing the older you get. The internal rate of return starts to come down a little bit because the cost of that death benefit is a bit more expensive when you get this old, but the numbers are still very good. And if you got to this point and you wanted to do something else, get out of this near the high point, there are things that we could do to make that happen. Ultimately, this product goes till your age 121, and the numbers just keep getting higher and higher. But the internal rate of return does drop because of that cost of insurance inside the product. Bottom line, the future of whole life insurance looks very bright when we do optimally designed policies like this one, where this is an exciting product to own and put money into it. And if you wanted the ability to fund it longer, we can do that. We can create the ability to fund longer inside of these. And realistically, they can be tailored to match your funding level. If you wanted to put in $10,000 a year or $100,000 a year. But the numbers over here are very similar. Now, I did one more design just for comparison purposes, where if you put in the $7,000, but we did the split design, how do those two compare? So I call it the $7K but better design. We're going to put in the exact same dollar amount, but we're going to design it better. Maybe you don't want to put in $18,000. Maybe you were really liking the look of that $7,000 one. Well, what if we did just put in $7,000, but we still did the blended design? Remember, the minimum on this blended design was about $4,155. How does this compare to the traditional design whole life? At policy year 20, you've paid in $143,000 in this case, $143,220. On the original one, $143,220. Here we've got total cash value, $218,611. Over here, traditional design, $199,000. We've got nearly $20,000 more dollars just in 20 years by designing it better. And in the first year, this one had cash value of nothing, $453 by year 2. This one, we're putting in the same dollar amount, but our cash value in year 1, $4,200, and in year 2, $9,000. We didn't really look at the cash value in the $18,000 one, but in year 1, end of year 1, $14,705. This is liquid cash value that's available through policy loans or withdrawals. Back to the $7,000. What does it look like by year 40? By year 40, we've paid in $242,000 in the better design. In the original one, we'd paid in $286. $286 compared to $242. $44,000 more we paid into the other one. In this one, our cash value is $774,000. Now, the reason we paid more into the other one is because we kept paying $7,000. Whereas in here, we kind of got limited on what we could put in right here. But what does that do to our cash value? $774,000 compared to $745,000. We paid in $42,000 less dollars in the optimally designed policy, and we have $30,000 more. In the traditional design, 4.21% cash IRR, 4.86 on that death benefit. And over here, we're at 4.64 and 5.18. Total death benefit that pays out over here, $892,000. And in the traditional policy, $877. Everything gets better when we do an optimal design. Now, none of these are guaranteed values. These are all based on the current dividend rate being paid out. There are guaranteed values in here, though, that say no matter what happens, you're still not going to lose money, even if it doesn't pay out a dividend above and beyond those guarantees. So all in all, these are just really great products. And this is the future of whole life insurance. I think the more that people hear about this, and hopefully you're going to share this with your friends and family, if you ever hear that they're needing life insurance, have them come talk to me. Or if you're in the market for it, book a meeting with me. My link is right over here. Let's look at this stuff and see how it might complement your overall financial portfolio. If we get talking to enough people, these are the types of designs that everybody's going to be buying. And they're not going to be stuck in those expensive products sold by a family member that got hooked into a multi-level marketing scheme, or they don't even get the advantage of getting the big commission because it goes to whoever recruited them. These types of designs minimize commissions and optimize the cash growth for your benefit. I hope you found this helpful. Let me know in the comment section below if there was something that I missed. I always welcome a good conversation down there, and I appreciate you spending some of your time with me today. Take care. We'll see you in the next one. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.